What's up, guys? A heavily requested video. I'm not gonna lie, I've been avoiding it a little bit only because, it is a little bit more of an advanced strategy and YouTube hates these types of videos. They don't show them to anybody. But guys, you've asked, I'm going to talk about it today. What I'm going to be talking about is an option strategy called the Iron Condor. I know that the Iron Condor, it sounds like it should be this like fire-breathing, mystical dragon. And I think the name Iron Condor actually makes it sound a little bit more intimidating than it needs to be. But to be honest, it's very doable. And it's hard with words, I think. That's why it's really hard on YouTube. So I'm going to jump down into the digital whiteboard and I'm going to show you some charts, graphs. I'm going to put everything in there visually for you so you can see exactly what it is. And really, this is going to be for traders with a small portfolio. I would say I started doing this when I had like less than $5,000 or so. And also we want it to be a kind of a neutral market, which is another reason why I haven't really done the video, because the market has been all over the place. But there are still some stocks that trade pretty flat, and the Iron Condor is a great opportunity to take advantage of that flat stock, collect a bunch of premiums at a pretty high probability, at a pretty low probability of loss, and also your max gain goes up and your max loss goes down by doing this. So what I'm going to do is I'm going to start and just explain what it is really quick, and then, yeah, I think you'll get it. You'll see. Now, full disclaimer on this. You have to have an idea of what a credit spread is. A call credit spread and a put credit spread. And I've done a video about that. I will link it down in the description below. If you have not seen that video, I highly recommend. Go watch that video because that's going to be a game changer for you if you're starting to trade options and you love the wheel strategy. Go check that video out first. Get an idea of what a credit spread is and then come back to this. Because if you watch this with no idea what a credit spread is, your mind is going to spin like you are some master physicist doing string theory and trying to solve the universe's problems. So have an idea of what a credit spread is before you watch this video. I'm being honest with you. Or you can just stick around for the jokes. That's up to you too. You can always stick around for the jokes and come back later at another time. Okay, so what we need to understand is that there's going to be 4 legs to this trade, okay? It's a 4-legged strategy. And let's talk about what those legs are and what that really means. We are going to be making 4 trades, okay? The first trade that we're going to make is we are going to be making a trade that is going to be a sell, kind of what we've done before. So what we are going to do is we are going to sell a call, a covered call out of the money. So that means above the share price. So we call that out of the money. So if say our share price is 25, just like we do for a covered call, we're going to sell that at like 27. But to hedge our losses, and this is what we've talked about in the credit spread, the second we're going to do is we are going to buy a covered call out of the money. And this one is going to be further out of the money. Now, yes, you're going to give back some premium here, but you are going to mitigate your losses. And this right here is called the call credit spread. You are going to get some credit for selling at a premium, and then you are going to give some back, but the difference is going to be in your favor. So you are going to get an overall credit. That's why they call it a call credit spread. And for most cases, that's pretty good. In a lot of cases, there's a little bit more probability for this to be successful than the latter, what we're talking about right now. But if you do this strategically, like I said, we can win this way. The third thing we are going to do, and this is what's really going to make this now an Iron Condor, is what we're going to do is we are going to sell a cash secure put out of the money. And then, as you can see, you kind of know it's coming, we are going to buy and give back a cash secure put further out of the money. And just for vocabulary purposes, the sells are going to be short. They're going to be called short strikes because both the buys are going to be further out of the money. Those are going to be our long strikes. So we see this is now called a put credit spread. Now these two call credit spreads and puts credit spreads, these two trades are what going to make the Iron Condor. So essentially all this Iron Condor is, it's a call credit spread and it's a put credit spread at the same time. That's really it. Now, looking at that, how can we make that a little bit more or less confusing? Let's show a profit and loss graph and show you exactly what I mean when we have just one of these credit spreads and then we add the Condor, what that does to our max profit on premium and our potential max loss. Our max gains for a call credit spread is when the share price ends up below our strike, our short strike. So max gain is when the share price expires below our short strike, which in this case is the sell option that we did. In a put credit spread, we get our max gain when the share price expires above the short strike. But now for the Iron Condor, our max gain is going to happen when the share price expires between our two short strikes. And our max loss is going to happen if the share price ends up on the outsides or further beyond our long strikes. Let's look at this on a graph. Okay, so this axis is going to be our profit and loss. And we'll make this right here like zero profit or loss. And here's how we're going to put this into practice. Essentially, let's see what we got. We got this stock FinInc. And FinInc right now is trading for $27. And I'm pretty confident that before my expiration date, I think that FinInc is going to stay between $25 and $29. So I think it's going to stay between $25 and $29. These are essentially what are going to become my short strikes or my short legs. Okay, so the first possibility would just be to do a call credit spread. So the first thing I'd have to do is I'd have to sell a covered call at my strike price of $29. And let's say I received an $80 premium for that. That's going to be a credit. And because this is a call credit spread, I would then have to buy a covered call. And I'm going to do that further out of the money to hedge my losses. So say I did that at $30 and I had to give back $60 in premium. So that means I have a net profit of $20. And what's my max loss? Well, my max loss is going to be the difference between those two strikes minus the premium. So the $100 in between this minus that. So my max loss is going to be $80. And here's what that would look like on this graph. We know max profit for a covered call is going to happen at the strike. So here's $29. So right here is going to be max profit. And as long as it stays below that strike price, we're going to have a max profit of $20. Now our break-even point is going to be the strike that we chose plus the premium. So $29.20 over here at $29.20, that's going to be our break-even price on a call credit spread. So this is break-even. So as long as it stays below $29.20, essentially we will be profitable. Not max profit, but we'll be profitable. But then our max loss happens over here at our long leg, and that's $80. This would be just a call credit spread with a max profit of 20 and a max loss of 80, which isn't really that great. So the other option would be to do a put credit spread. The same thing we do, we'd sell a cash secure put, and we'd now do this at the lower strike of $25. And that would say get us a premium of $80 credit. Sweet action. Then we'd buy a cash secure put further out of the money. I'd say $24, and we'd have to give back $60. And then we now have a net here of $20. And this would be the same exact max loss. Max loss would be $80. Once again. So if I did this in red now, we'd come down here and max profit for a put credit spread would happen here at $25. And as long as it stayed above that, it would be profitable. So as long as it stayed up here, and then the break even would be $25 minus the premium that we received. So that'd be $24.80 right over here. And then at $24, we'd get to our max loss. So this would be the opposite of the call credit spread. This would be the put credit spread. But this alone isn't the Condor, because essentially with the Iron Condor, we are going to double our profit because we are going to get this premium and this premium. So our max profit is going to go from the $20 up to $40. Here's what that graph now is going to look like. So now our max profit is going to happen in between our short strikes. So at 25 here and 29, that's going to be our max profit. And as long as it stays between those, like you said, we talked about this, as long as it stays between those, we're going to get our max profit now of $40. And this is called the body of the Condor. Now our break evens now are going to move, and those are going to go out to here at $29.40 and $24.60 over here. These are known as the wings of the Condor. But now here's the beauty thing about our max loss and what we've now just done to our max loss. The share price can only go one way. it can only go outside of my long strike on one or the other side. So essentially, when this gets to expiration, you are going to collect the full premium from one of the two sides. So what has that now done to our max loss? Well, now, let's say it burst through here and it got higher than $30, which is at our max loss. But now what happened is our max loss, which we calculated was $80 before, but now we're still going to get the full premium from the put side, right? So we're actually going to minus another $20 in premium. So now our max loss only becomes $60. So we've doubled our max profit, but we've lowered our potential max loss by $60. And the same would hold true here. Say it dove right down to zero. Well, we would take on max loss on the put credit spread side, but we'd get our premium, our full premium, from the call credit spread side. So here, if it were to dive below $24 here, we'd have a max loss of $60. The 80 initially minus the 20 from the other side of the Condor. And guys, you can mess with the width of the body, the width of these wings right here. You can do whatever you really want with those to try and get the most amount of profit that you want. But I'll leave you with a couple of different tips and things that I've learned from doing this that you might want to consider if you're going to try this strategy. Number one, you're doing 4 options trades. So this can be really hard to get filled. And I see this as the case, especially on Robinhood. So to mitigate that, guys, you're gonna have to stay pretty close to the share price. If you keep your short legs pretty close to the share price, it probably will get filled. The second thing, you guys know I love to close options. You can close these. I tend to close them just like all my other options at somewhere around 70% profit. That's just the way I like to do it. You can be a little more greedy than me. That's completely up to you. The other is to keep the wings kind of short and tight. And what I mean by this is you don't want to separate your hedges in your spreads. You know, keep them close because like I said, there's no risk in, yes, you're going to get a lot more premium, but that's also going to raise up your max loss. So I tend to keep my wings nice and tight to lower my max loss. Like a side note, like if you want more premium, don't raise the wings, just trade more condors. Like do more contracts at tighter wings. Now to put this into practice, guys, let me show you how you do this on Robinhood. Let's open up Canopy Growth. I know that's JJ Buckner's like favorite stock right now, and he's been learning and sipping the Kool-Aid for options. So we'll jump on, and what we're gonna do here in Robinhood is we're gonna click trade. So what I'm gonna do is I'm gonna press trade options. I'm gonna go a little further out with my expiration, and first I'm gonna do the sell side. What you have to do in Robinhood, top left, you're gonna press select. I am going to first sell my call at 17. I am then going to buy my call and give $10 back, so it's going to be a $7. So now the first part of my Condor is set. I just did my call credit spread. I'm going to go now to the put side, and I'm going to sell out of the money at, say, $14. And then I am going to buy further out. I did 14, 15, 14. When you select continue, it recognizes this as an Iron Condor, okay? So here are, if I review these two, my two sells are at 17 and 14.50, so that's gonna be my body. My wings are gonna go out to 17.50, from 17 to 17.50, so 50 cents. This would get me a $15 premium. If I press review, I'm gonna put in a market price. I'm gonna go a little bit low. Let's see if it'll give me 0.15, let's see. Do one contract. 0.15. If I review this, my collateral is going to be $50. So once again, that is going to be the difference between my wings, and it's not really $50 that I would lose. That's not my max loss. My max loss is actually $50 minus the premium of 15, so that's going to be a $35 max loss, and I would press swipe up to submit that right now. We're out of market hours, so it won't get filmed right now. A huge shout out and thank you to all my Patreon members. You guys really pushed me to make this video, and after making it now, I'm glad I did. If you're curious in joining that Patreon chat, I'll leave a link to it down in the description below. I think we're 50 members strong now, 50 patrons strong. Thank you guys so much. That's super humbling. I will leave a playlist of my entire wheel strategy as well as a credit spread if you want to check that out. And until I see you guys in the next one, stay positive, work really, really hard. Always, please be kind to other people. Hope you have yourself an amazing day and even better